How should you fund a $100,000 expense in retirement? That's the question we're answering today. Whether the expense is for a pool or maybe it's that RV you've been dreaming about, funding a $100,000 expense in retirement can have a massive impact, not only on your tax bill, but your overall financial plan. So where should that money come from? In this video, we're gonna walk you through the different funding sources available for paying for that $100,000 expense in retirement. Not only will we go over the different ways you can pay for it, but also the tax impact of each one of those decisions. And be sure to stick around to the end where we cover 2 unique strategies to help keep your tax bill low. Hi, I'm Jordan Curnutt, certified financial planner, specializing in helping retirees make smart financial decisions with their hard-earned money. Now, the place to start is assessing what options do we have available to us. We're going to start by taking a look at a quick case study, Steve and Cheryl Smith, just taking a look at what they have available and just a brief overview of how each of those different options may or may not make sense for their situation. So the first place I want to start is by looking at their bank checking account. Now, this might be the most obvious place, or the first place you think of is just using cash to cover an expense like this. One of the things that we want to be real careful of and cognizant of when we look at using the bank checking account is that we don't draw it down too low. We want to make sure that you maintain your emergency fund in retirement. So absolutely, the bank checking account is the first place we want to consider, but at the same time, we don't want to overuse that funding source. The next place we'll look is a joint investment account. Now, this isn't a retirement account. This would just be a brokerage account. It could have stocks, bonds, mutual funds, ETFs. Typically, they're invested in the market, so they're going to be bouncing around and more volatile than a cash investment. And the thing that we're going to need to be worried about from a tax perspective here is going to be something called capital gains. Now, capital gains have a favorable tax treatment to some of the retirement accounts we're going to look at in a moment, but we still need to be aware of what selling investments inside of that account will do to our tax bill. Next, we can see that both Steve and Cheryl have traditional IRAs. Now, traditional IRAs, you probably contributed to these accounts consistently throughout your working years, and you got a tax deduction every year for the money you put in. On the back side of that, that means that when we take money out of those accounts, it's going to be 100% taxable as ordinary income. So again, not a deal breaker, but we just need to be very aware of what taking money out of these accounts does to our tax bill. And the last option that we're going to look at today is the Roth IRA. So in this scenario, both Steve and Cheryl have $100,000 amounts available in their Roth IRAs. Again, they were likely saving into these accounts diligently over their working years, and money on the way out of Roth IRAs is not taxable. So it's that inverse relationship with the traditional IRA. Instead of getting the value up front with the Roth IRA, we're going to be able to access that tax-free on the way out. So those are the 4 different funding sources that we're going to look at today. Now let's flip over to the individual scenarios and see how taking withdrawals from each one of those buckets of money impacts your tax bill. Now you can see we have 3 different scenarios that we're going to look at today. And let's start by looking at scenario number 1, which is our baseline scenario. So ignore the $100,000 expense. This is just everyday life. And then we're going to have to stack that $100,000 expense on top of that. So let's dive into number 1. In scenario number 1, we're looking at the tax year 2024. And what this year is going to look like from a tax perspective is we've got some interest happening on our cash. That's great. You can see some qualified dividends at $2,000, total dividends at $5,000. And then the vast majority of our current living expenses in this scenario is $90,000 of distributions from those IRAs that we just looked at. We can see that from a tax perspective, that's going to be one of the biggest drivers of our tax bill in this scenario is just our monthly income coming from the IRAs. And we know that if we fund a $100,000 expense on top of that, we're going to have to include what's already happening. So keep that in mind as we go through these scenarios. We didn't realize any long-term capital gains in this year in this base scenario. We have total income of $100,000, $29,000 of standard deductions, bringing our taxable income to $70,800. And when we get down to our total tax of $7,792 in this scenario. Now, before I dive into scenario number 2 and then scenario number 3, I want to acknowledge that 2 of the funding sources that we've already been over are going to have the exact same tax impact as if we did nothing. So if we utilize the cash that we talked about for the first funding option, it's not going to have a tax impact. You can pull money out of your checking account. You can pull money out of maybe a high yield savings account that you're using for your emergency fund. And that withdrawal is not going to show up on your tax return. So for all intents and purposes, the scenario of using cash to fund that expense is going to be exactly the same as our baseline scenario. Same thing with the Roth IRA scenario. The advantage of the Roth IRA is withdrawals on the way out are completely tax-free. So when we look at a scenario where we add a $100,000 Roth IRA distribution to pay for that $100,000 expense, again, it's going to be the exact same tax scenario as scenario number one. So when we look at an individual tax year, those far and away are going to be the two most efficient ways to cover that $100,000 bill. But don't get too carried away with that yet. I want to get to scenario number two and scenario number three, and then talk about some unique ways that we can maybe blend these things together. All right, so scenario number two is we're looking at that investment account. We're going to hold everything constant in this scenario, except now all of a sudden we have a $50,000 capital gain. You can see that's different than our baseline scenario. So what we're looking at is we have gross proceeds of $100,000 in this scenario, and then we have what's called a cost basis of $50,000. Now, what your cost basis is, think about it in the most basic terms. It's what you invested into the account plus any dividends or capital gains distributions that were reinvested. So in this scenario, we're saying that maybe an initial investment was made of $50,000, that $50,000 grew to $100,000. Now, when we sell that $100,000, that 50 that's grown to 100, we have to realize that $50,000 as a capital gain. And as long as we've owned that investment for an excess of 1 year, we get what's called long-term capital gains treatment, which is favorable to ordinary income. So that's where this $50,000 long-term capital gain comes from. Now you can see instead of having $100,000 of income for the year, we have $150,000 of income. And our tax goes from $7,792 to $11,805. So a little bit more, but we were able to preserve our cash and our Roth investments in this scenario. So now let's look at scenario number three, the traditional IRA. So as I mentioned before, when we take money out of a traditional IRA, it's going to be the most tax inefficient in this scenario. As you can see, everything's still held constant, except IRA distributions go from $90,000 for the year in our previous scenarios all the way up to $190,000. So we're funding that $100,000 expense entirely from the traditional IRA in this scenario. Now we don't have that long-term capital gain here anymore. Total income is up to $200,000, hold everything else constant, and you can see our total tax jumps up to $27,542. So of the three scenarios we have here, definitely the least advantageous option in an individual tax year to fund the entirety of this expense, all from the traditional IRA. So now that we've seen how each of these different accounts impacts the overall tax bill, I want to dive into maybe some unique planning strategies that could make sense. One of the things that we have to remember is this doesn't have to be an all or nothing decision, meaning we don't have to use only cash. We don't have to use only our traditional IRA. We can have a mix of these different funding sources to get us to what might be the optimal mixture for you in this individual tax year. In the United States, we have a marginal income tax bracket system. What we're looking at here is our base case scenario, and I want to show you how that income is currently taxed. So this is without funding any of that extra $100,000. But our ordinary income in this scenario, you can see of that, the first $23,000 is taxed at 10%, resulting in $2,320 of tax. And the remaining $45,000 is taxed at the 12% rate, resulting in $5,472 of tax. So we never even get to the 22, 24, and plus tax brackets because just by funding our basic monthly income needs, we never get to that level. Now, I want to contrast that with scenario number 3, where we looked at taking a $100,000 withdrawal from our traditional IRA to cover this expense. Now you can see that our total income is at $168,000 after our deductions. And what that means is that $74,500 of our dollars that are taxable are going to fall into the 22% tax bracket. In this scenario, it results in $16,390 of additional tax because those dollars got bumped up into that 22% bracket. So here's a planning technique I think that it might make sense for you to consider. What if we used 2 different buckets of money to achieve this goal? Here's what I mean by this. Again, we're back to the original scenario, so we haven't taken any withdrawals from anywhere yet. We're in that 12% bracket, but we still have room. So what might make sense for you and your family is, what if we use the traditional IRA to fill up that 12% bracket with withdrawals from the IRA and then stop? And then we take the rest of the amount that's needed to fund that $100,000 expense, and we use one of our other account types. We look at our cash, we look at our joint account, we look at our Roth IRA, accounts that don't have that same negative tax impact, and we take a hybrid approach to solving this problem. So the second strategy that I'd like you to consider is, what if we break this up into 2 tax years? So let me rewind, and each one of these scenarios that we're looking at is all occurring in 1 year. One of the strategies that we look at with clients fairly regularly is, if this is a goal that's looking to be funded maybe towards the end of a calendar year, what if we split it? What if we take 50% of the funds that you need to achieve this goal at the end of the maybe 2024, and we fund the rest of it in January of 2025? What this does is this allows you to get that income split into 2 different tax years and help us maintain those lower income tax brackets that we looked at before. So as you can see, funding a $100,000 expense in retirement isn't straightforward. It depends on the funding sources that you have available, the timing of when you use those sources, and by just how much you use each one. Taking the time to deliberately plan out how you fund that $100,000 expense can make a huge impact on your overall tax bill. If you found this video helpful, don't forget to like and subscribe for more insights on managing your finances in retirement.